This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So we're now going to get there. We're actually going to go through and begin to look at the accounting. So we've gone through already, haven't we, and introduced what leases is all about. We've gone through there and identified whether or not the contract between the two parties, so was it company A and company B, actually give rise to a lease, and therefore the accounting is done under IFRS 16. And then in the previous video, we just looked at that small part of the syllabus, didn't we? Whereby we had a total payment, and that total payment related to a lease element and a non-lease element, and how to split that based upon standalone prices. Okay. Now we're going to look at the accounting, and when we're looking at the accounting, we're going to look at it first of all from the lessee's perspective. So remember, from the lessee's perspective, all leases are now brought on to the financial statement, so the statement of financial position. And in doing so, we are going to have to recognise, is it there a right of use asset and the lease liability. Okay. Remember, what was the exceptions? Can you remember what they were? Yes, if the lease was less than 12 months, if it was a short life, or it was of low value. So if it was short life, low value asset, and again, you had to make the election at the start of the lease, then therefore you could just expense the lease rental straight line over the life of the lease. Now we're looking at 99% of leases now, okay, which are not low value and which are not short term, okay, so are greater than 12 months. So what happens is, as we've said, you recognise the asset, you recognise the liability, and the way in which it's worked is that first of all we set up the liability. We work out what the liability is, and the liability is the present value of the rental or lease payments over the life of the lease. Okay, so the most simple scenario is that you've got some fixed payments. Again, you need to be careful whether they're in advance, whether they're in arrears, and discount them back to present value. Okay, I'd have thought that in this paper now, you will be given the present value of those payments. Okay, you could potentially have to do it, but I think that's just beyond the scope of the syllabus. But in the real world, you may have to. Okay, so any fixed payments in the future, you discount back to present value. Okay, so that's nice and straightforward. The rate that you use is the rate implicit in the lease. Okay, again, that will be given to you within the question, and the rate implicit in the lease, if you're interested, is the IRR, the internal rate of return of all those payments. Okay, so the break-even discount rate. You would also include any variable payments that there may be based upon the rates of inflation. Okay, so again, you need to be reasonably certain about what the rates of inflation are if they are index linked, to be able to go through there and record those with reasonable certainty. Any expected residual value guarantee you would include as well. So at the end of the lease, maybe the asset has some worth. So you need to look at the worth of the asset, a little bit like the residual value of your asset. Here, you need to take that into account and discount that back to present value as well. Okay. Any penalties for terminating the lease? So if you expect to terminate the lease and you're reasonably certain that you will terminate the lease early, maybe, and will therefore have to pay for it, you should include that payment in there as well, because the likelihood is you are going to pay it. Therefore, we should recognise the obligation today. Okay, and likewise as well, maybe you have the option to purchase the asset at the end of the lease term. So maybe for a peppercorn small rental, again, you would need to incorporate that within your present value of minimum lease payments. Okay. Again, small tiny note there. If the implicit rate of interest cannot be worked out, just use your incremental borrowing rate. So what's your normal rate of borrowing on the open market? Okay. So what you do there is you work out the value of the liability. So effectively, you're going to credit your lease liability with the present value of those lease payments. At the same time, what that then means is that then gives you the starting point for the value of the asset. Okay, so you credit your lease liability, debit the right of use asset, but you then need to go through there and make adjustments. Okay, not to the lease liability, that's set. Okay, that takes account of the payments, whether that's the initial payments, the rental payments, the variable payments, the residual value payments, or the guarantee, the termination, the fact you might pay to buy the asset at the end of the lease. That's all dealt with on the liability, and that goes as well to the value of the asset. Any subsequent areas of adjustment now just impact the value of the asset. Okay, so if you've got any initial direct costs, okay, maybe setup costs of the asset, maybe any legal fees, solicitors fees that there might be, okay, stamp duty if it's a building, or any taxes that there may be. Likewise, any estimated cost for dismantling, like you've seen previously in IAS 16, like you've seen in IAS 37, you recognise the asset and then recognise the provision and then unwind the discount on the provision. Okay, and then just note if you have any incentives, so maybe the supplier, the lessor if you like, incentivizes you at the start of the lease, so gives you a little bit of a reimbursement, a payback, then you're going to credit the bank. Start again. You're going to debit the bank, aren't we, because we received the money, and you will credit the value of the asset. Okay, so just be careful there. Any incentive, so if you like a reimbursement from the lessor, reduces the value of the asset. Okay, got that? Excellent. If you like, as we've seen, that's how we've thought about things throughout. Look at things initially. What then happens subsequently? Because what we have now is we have the liability, we have the right of use asset. We've got the asset on the top of the statement of financial position, the liability on the bottom. What's the subsequent treatment over the life of the asset? The asset is very simple, isn't it? You just go through there and charge depreciation. So you charge depreciation through profit or loss, and that depreciation is accumulated on the statement of financial position and reduces the carrying value, doesn't it? Nothing too difficult there. Again, just be very careful. Specific rule from IFRS 16. The depreciation is based on the earlier of the useful life and the lease term. Why the earlier? Because that's where you're going to get the benefits from. Okay. If the lease term is shorter than the useful life, then you're only going to get the benefits, aren't we, from the lease term. Okay. If the lease term is longer than the useful life, then you get the economic benefits over the life of the asset, don't we? Okay. Yeah. All right, you're still using it after its useful life, but depreciation reflects the economic life, doesn't it? Not the physical life. Okay. Again, just be careful. There is a caveat, unless ownership transfers, in which case we will always use the useful life. Okay. So let's just say that the lease term is shorter than the life of the asset. Then what we've got there, if we have the option to buy and transfers, we're not going to depreciate it over the lease term, which is shorter. It will be the useful life, because we are going to buy the asset and we are going to use it over that prolonged period and therefore get the benefits. Okay. Just be on the watch for that. And then you've got the lease liability, so your financial liability there at amortized cost. So effectively, what you've seen there is it under IFRS 9. Okay, you can get your financial liabilities at your amortized cost. Okay, excellent. So looking there at your table. Okay, in terms of looking at your opening liability. Looking at applying the effective rate of interest, looking at when the payment is made to work out the closing liability. Okay, there you go. Excellent. So that's the technical aspect. That's all that you require. Let's go through now and have a look as well at the actual example itself. Okay. So what have we got? Read the requirement first. It says demonstrate how the lease will be accounted for in the financial statements over the 5-year period. So again, financial statements, I'm thinking SFP. And is it statement for profit or loss? Okay. And what does it go through and say there? It says on the 1st of January 2015, Plum entered into a 5-year lease of machinery. The machinery has a useful life of 6 years. So whenever we're doing any depreciation, it will be over the shorter period, which is it as 5 years. Okay. It says a finance lease because when we look at it from the lessor's perspective later, that gives rise to a finance lease. Okay. Don't worry about operating finance from a lessee's perspective. Never mention those words. Only under a lessor's perspective. So any depreciation will be over the short, which is their 5 years. The lease payments are $5,000 per annum. So when we're working out the value of the liability, we'll need to discount those back to present value. Again, just note, the first payment is made on the 1st of January 2015. So if the lease is 5 years, so is that T1? So 5. Just be careful, the first payment, again, we're starting a little bit financial management-y, aren't we? But the first payment there is today at T0. Okay. T1 to 5. Okay. So we're going to have to discount back those payments to present value using the rate implicit in the lease bonus, because we're given the rate implicit in the lease and the total of present value. Minimum lease payment is 22730. It's been given. Could we work it out? Yeah, I think we could. Ooh, I'm being brave or foolish, one or the other. Let's have a look. I'll put it in a different colour just so that you can appreciate that it's off syllabus, if you like. So to work out the present value, is it a cash flow multiplied by an annuity factor? Okay, that's about right. The key bit here is the annuity factor is from 0 to 4, isn't it? I know it's a 5-year lease, so years 1, 2, 3, 4, and 5. But there are 5 payments in a 5-year lease. The first payment is today at T0, and then T1, 2, 3, 4. Okay, with T0, that makes the 5 payments. So what we've got here is that the cash flow is 5,000. An annuity factor from 0 to 4 is 1 plus an annuity factor from 1 to 4. Okay, and I think I'm told, I'm led to believe that that's 5,000 multiplied by 1 plus 3.546. Okay. Now you would only ever be able to know that from your tables, wouldn't you? Because that's all you use. You could actually work it out and calculate it. So if you tap that onto your calculator, if my calculator works, 1 plus 3.546 is 4.546. Multiplied by 5,000 gives me 22,730. Okay, so that is the present value of the lease payment. So what's going to go through and happen there is that when we go through and look at my statement of financial position, okay, will it be there, my statement of profit or loss? On the statement of financial position, I'm going to have my right of use asset, and then I'm going to have my liability, aren't I? Okay. My right of use asset starts off there. Is that at, let me just check, was it 22,730? And the liability is at 22,730. Okay. What then happens? Well, from the assets perspective, we need to charge, is it depreciation? The liabilities perspective, we need to charge interest, don't we? Okay. But just be careful, we haven't finished with the value of the asset. We need to go through there, don't we, and begin to look and see whether there are any direct costs, any incentives that have been paid. Because what you've got there is it says to obtain the lease, we incur direct costs of $1,000 in relation to the arrangement of the lease. And also there is a $500 reimbursement. Okay. So what you've got there is that the direct costs are added on. You reimburse, is it 500, which reduces the value of the asset. The debits and credits are in the answer at the back. I'm not going to talk about them now. Just repeat the answer, don't I? 22730 plus 1,000 less 500. Does that there give me, is it 23230? That 23230 is divided or spread over the life of the lease, which I think is 5 years. So my depreciation is 4646. So I have there, is it 23230 less 4646. So here, let's just say we're looking, is it at year 1? Okay, so 23230 less 4646 gives me there, is it 18584. Okay, there we go. Okay, excellent. So there you have it. Okay, that's the value of the asset at the end of the first year. You then depreciate it by the same 4646 every single year. Okay, not very exciting. It's very exciting, isn't it, from the world of accountancy? Okay, because you've got the initial payments under the lease, and then you have to adjust, don't we, for, was it the direct costs and also the reimbursement. Okay, you've then got to be careful in terms of the liability. Okay, because the liability, yes, is done, is it under amortized cost? So there we start off, is it with, is it year 1? Okay, because in year 1, you know, amortized cost, we normally start off with our brought forward, don't we? Which will start off the same here with 22730. Okay, remember that was the initial value of the right of use asset before adjustments and also the value of the liability. We just need to be careful because normally what you do with your amortized cost is you charge your interest, and then you look at the payment, the cash balance. Here we need to be careful because the payments are in advance, so we need to look at things in chronological order. Because what then happens there is you have the cash. So was it $5,000 per annum? Okay, is what we make as a payment. For reasons you will see in a moment, we then look at the outstanding capital balance, which is 17,730. Okay. You then have your interest. So remember, the interest is at the rate implicit in the lease, which is there, is it as 5%. And if you tap 17,730 times 5%, gives me 887. Okay, giving me there a carry forward figure, is it of 17,730 plus 887, is that 18,617. Okay, excellent. Why is that important? Because what you've got now is you've got the interest at 887, which goes to the statement profit or loss, and the carry forward of 18,617, which goes to the statement of financial position. Okay, so I've got interest, is it there, of 887. The liability is there, is it at 18,617. Okay, there we go. Excellent. Everybody happy with that? Okay, if you want to think about things from a cash flow perspective, the depreciation, if you like, there forms part of your normal depreciation, doesn't it? So that's non-cash. So you would add that back, wouldn't you, in your statement of cash flows if you wanted to add that in. You've got there, is it the interest, obviously, is part of then your finance costs, so you need to go through there, wouldn't we? And adjust for your finance costs within your operating activities as part of your indirect method, and then look at the interest that has been paid in the year. Okay, there we go. Okay, in terms of the asset, you could also then look at the purchase of an asset as part of your financing activities and your finance lease. But I think I'm just going a little bit too far there. I want you to focus on the SFP and the statement of profit or loss. Okay, I think the asset's reasonably straightforward. Once you've capitalised it as a right of use asset, depreciating it, The liability poses some problems because here you've got to be careful. You've got your payments in advance. Okay, so therefore that means that when you write things in chronological order, it's different to what you have normally seen when you look at things using your amortized cost method. Normally, the first thing you charge is interest, but here, because you make a cash payment, you reduce the outstanding balance first by the cash payment, and then you charge the interest on the outstanding capital balance. If the payment was in arrears, it would be very simple. It's not in arrears in this example, but just note that cash payment that you have there would resort to its usual position at the end of the table. Okay, so if it was to be in arrears, the position would change. Okay, there we go. Don't worry so much about the advancing and the arrears. What I'd like you to go through and do in your own time is work through that table using the answer in the back to check that you're right, to take it to year 2, to take it to year 3, to take it to year 4, and then to take it to year 5. Okay, you should find at the end of the year 5 that there is no outstanding liability and that everything has been paid off. Okay, so a reasonably straightforward example. What I would recommend is make sure that you've got the most up-to-date study text and revision kit from your chosen tuition provider, and work the examples and work the questions that you've got in both the study text and the revision kit to make sure you're happy with it. It might be worthwhile as well seeing if you can get access to an F7 revision kit and study text in case there are more, if you like, examples to work through in there as well if you've previously gone through and studied F7 when the old Leases standard IS 17 was in place. Other than that, that's it from me in terms of lessee accounting for now. I'll see you in the next video when we begin to look at lessor accounting. Enjoy.